The FOMC minutes came out and boosted the markets. That's despite some hawkish talk pointing to more rate hikes that go further than the market anticipates. If you really break it down, what we saw was very interesting was the word tightening was used 14 times in the recent FOMC minutes. The prior one was only used 4 times. And the conclusion is, well, I don't know. And the markets, like I said, roared. The big question here is whether or not the market will fall and make the cocoa bear happy, or if it will continue to go up like it did today and confuse the heck out of her. Clearly, we can see when the minutes came out, we saw the market rip and a subtle pullback, looking like a bull flag here on the 5-minute time frames for the SPY. Now, if we really start to break down what took place today, let's take a look at the 11 sectors that make up the S&P 500. We have XLY, that was the top spot, and then we have defensive sectors pushing more towards the bottom. So this was a more risk-on type environment. As you can see now, if you really dig into consumer discretionary, what was the top performing industry within consumer discretionary? Because as we all know, consumer discretionary has been getting beaten down. Now, if we really look into that, we look at home construction. Interestingly enough, right, it was up 4.87% today, this index here. That's a very powerful day. Now, that is despite sales of newly built homes tumbling over 16% in April, while the prices soared for those homes. Now, if you take a look at something like HGX, which is the housing index, this is clearly in a downtrend, putting in lower highs and lower lows. One positive sign that we're seeing is the relative strength between housing and S&P 500 is putting in a positive divergence, and the MACD here too as well. But is that enough to really break this downtrend? No, absolutely not. One day does not make a trend. You can look at HGX. You can also look at something that's tradable ETF like ITB, which is the U.S. Home Construction ETF. And you can clearly see here, it was a very powerful day, up 4.15%. But be mindful, it's in a primary downtrend and the volume was quite lackluster. Despite seeing the positive divergences, you must just pay close attention to that trend. Now, if you really break it down even further and you look at specific home builders, let's look at a large cap like Lennar. Well, this is a weekly time frame. Where's Lennar pulling into? Well, Lennar's pulling into the post-pandemic high. So we're finding some support at that level. It was prior resistance, then support, and we're acting as support at this level. So it's holding up here and we're starting to see some bounces from these levels. Does that mean that we're going to rip up to all-time new highs? Absolutely not. The primary trend still remains down, although we are getting extended from some of these moving averages, but just be mindful that they are curling themselves over. If you look at the PMO on the weekly time frame too, it is below 0, which is not healthy. RSI is below 50, which is not healthy. So the pressure is still to the down side. Now, this chart really does look something similar to IWM. Go figure, right? IWM, right? Small caps and housing, they do kind of go hand in hand. Michael Guyad wrote a really good white paper, award-winning white paper about the lumber to gold ratio and why it's important to watch prices of lumber, right? And how that's relative to homes. And what we're seeing here as far as small caps go, we are also something very similar to the housing index. We're testing these prior areas of resistance. We gapped above it. Now we're pulling back into it and finding a little bit of support. Does that mean we're going to start moving up significantly higher? No, the primary trend is still down and the Fed is still on the path to tighten. So until we start seeing these moving averages flatten out to start curling back up is when we can get a little bit more excited. Even if you look at the housing index side by side to the S&P 500, right, I pointed this out a while ago because in 2008, before the financial crisis, right, housing peaked in, I think, May or June the prior year or so. So it gave us a big heads up notice, 5 or 6 months heads up notice that, hey, there's something fishy going on with housing. Well, in May this prior year, it also did peak out. And as you can see, that gave us an indication that something was a little funky. You can see here it hit a high and another high measured, but the S&P 500 hit a new high. Okay, and that divergence played out to the downside. Same thing happened here that we talked about where the S&P 500 started ripping up higher, but housing wasn't matching that. And guess what? It ripped down to the downside. So what do we see here? Well, I don't really see a divergence at this particular time building. All I see is two indexes that are pretty much well correlated to the downside as it stands. Okay, so be mindful of this overall trend. Now, when housing's down, right, you would think that, that's going to put pressure on the economy, which it has. And if you look at stuff like oil, with rising costs of oil, that's also putting pressure on the economy. Now, oil has been just trending sideways. If you look at something like XOP, I'm not going to bring up that chart, but that did pop off today to the upside, getting outside of its weekly expected move. So this has been getting very tight. Are we going to see a pop more to the upside? Is that going to cause more issues? Well, we will see here very shortly, right? It's coiling up very tightly. And this kind of stuff, what does this do? Well, it brings down and drives down consumer sentiment. And you can see consumer sentiment is pushing brand new lows over here too as well. So this, there's just interesting things overall going on that we need to be very mindful of. Now, we have some big dogs reporting earnings, mainly NVIDIA, right? So NVIDIA reported earnings today. What took place? Well, it's down around 7% in the after hours. The earnings expected move was around a plus or minus 11%, okay? So what happened? Well, we got the earnings and it came right about down to its lower expected move. Now, can this easily go up, right? We still have a lot of time before the market actually opens up tomorrow, so we'll see where this goes. But if we start getting hit to the downside or if it gets out of the side of these expected moves, that's going to affect the overall market, being how big of a player NVIDIA actually is. If we take a look at another one like Snowflake, this one's down around 14% after hours, so this one's also getting hit hard, okay? Now, let's take a look at the S&P 500, okay? Where do we stand overall? Still, we're in a primary downtrend, right? We're seeing a little bit of relief. We talked about the possibility of a bounce on our prior video, looking at some positive divergences, and we also had the summation index and things starting to curl up. Is that enough to get the market into a full-blown bear market rally? I don't have that specific answer for you, but we can at least be prepared for something that were to happen. Now, what I'm looking at is the upper weekly expected move. I'm going to go into the 15-minute time frames to tell you how we can potentially get there and some areas of confluence resistance that I find quite interesting. So if the market does want to perpetuate itself up, I'm going to show you where we might run into, like I said, resistance. We also have the MACD curling up. RSI is below that 50 marker, and we're below all those key moving averages, both the 20, 50, and 200. So let's look at the 15-minute time frame. 15-minute time frame, we broke out of this downtrend, small, right? Boom, came into this prior resistance, and then we're starting to pull back a little bit, okay? We're starting to build in some higher lows, so that's positive. Okay, so the market is making a little bit of ground here. We're back above that 5-day moving average, which is also positive. Now, I want you to pay attention to the expected move. It's right at about 402.50 or 402.40, okay? Now, I found this to be very interesting. If you apply anchored VWAP to the monthly time, to the start of the month, where is the month-to-date trade-weighted average? Well, based off the anchored VWAP, it's 402.48, which is spot on to the upper risk range itself. So what can we potentially see here, as this is in confluence with also the expected move? That could very well be a strong area of resistance. Now, as the market took off on FOMC minutes, right, we're getting a little bit of a pullback. After hours, right, NVIDIA, they're getting hit a little bit. So what do we need to pay attention to? Well, maybe perhaps the market wants to pull back slightly, but if it starts getting below these levels over here, all right, that can trigger out some more sell side activity to the downside to potentially test this low. But as it stands right now, we are, like I said, putting in higher lows, which is positive. So what you want to do is, and we ran right into this area of resistance, right? We came up, we back tested it. So if you are going long here, just understand that the upside is not nearly as rewarding. It's kind of muted to the potential of downside. So you need to make sure that you're managing your risk on these specific trades. So for example, if I were to take a trade, if it were to come down into this range, I would have a stop just here under the 5-day moving average. And then I would see, if it starts turning back up, obviously we can see if it can play. That would give me a better risk to reward type trade. So that is what you should be paying attention to going into tomorrow's trading session. Now, if we take a look at the VIX broke down from a key trend line here too as well, and it started to backtest slightly there. The low end of the VIX that I'm watching for is right at about 26.50, where this gap fill is. So if this were to come down here, this is where I'd be starting to look to take profits or also start new short positions. I don't know if it's going to get down there or not. And then to the upper end, I'm looking at about 32 to potentially even around 34 of these previous swing highs. So that is something that we need to be very mindful of, because the VIX hasn't really been moving much, right? But we're still at elevated levels, right? We closed at 28.37. So the market's volatile. We're seeing a lot of chop. Be very mindful of that. If you take a look at the Qs, Q has a little bit more room to run here to the upside. We have the MACD curling over, right? This body, today's daily body, engulfed the prior day's body. It was a hammer candle. We're starting to move up a little bit. RSI is still below that 50, and we're still, in a primary downtrend. So even if we were to come up to this upper risk range, which is around 300, that's a nice move. But remember, it'd be coming up strong into a 20-day moving average. So be mindful of that one. If we look at the 15-minute time frame, price action did get back above that 5-day moving average. So that's positive. You can see there's some stickiness right here, okay? So right in this 295 area on the Qs, that would be an area to break to potentially see it come back up and try to test this upper risk range. So, NVIDIA's down in the after hours. Perhaps we get a little bit of a pullback, and then just watch to see if it takes out today's low, today's trading low here. If it does, then I think that opens the door to more downside. I mean, shoot, it can also be something like this where we undercut it, and then you could try to pick it up on strength to see if it could come up here and start taking it out higher, and then have a stop below that previous swing low, right? So if the point here is you got to look for swing lows to potentially have stops at where you can, buy into some strength where it kind of pulls back into it and so forth. If you're not doing that and you're just kind of entering in long, as it stands right here, just understand that, hey, if you're entering in long here, the, key resistance is up in this area, which will show you here the monthly volume weighted average too. But if you do that and you have a stop loss down here, you're looking for a 1-for-1 risk to reward, which isn't giving you really the benefit of the doubt. It's not laying odds really. And if you break that down even further, and like I said, if we look at the month-to-date anchored VWAP, you can see here it's pretty well aligned with the upper expected move here too as well. So the 5-day moving average, it's declining. It's been acting as resistance. We broke above it, and now we have the poor earnings going on right now, or the market's reacting poorly to it. So we'll see here if it starts taking out that this low right over here, perhaps that opens the door to more downside. Always look for potential undercuts and then see if strength comes back in, right? So we are getting some bullish developments, but like I said, we're primarily in that downtrend. Now, here's where the sore thumb is, okay? HYG. This is where I kind of am a little bearish here. So HYG, although it was a very, very powerful day to the upside, right, up 1.52%, and it's overall in a downtrend, and this move is blasting through its weekly expected move. Okay, so it's getting way outside of the risk range right here, and typically 68% of the time, right? 68% of the time, the options market ends up being correct, and it comes right back in with those risk ranges. So this to me looks like a potential short play. If I break it down even further and I look at something like the 1-hour chart relative to the S&P 500 here, so we have HYG up top. All right, and then we have SPY down here. You can see HYG put in a higher low, which was a clear indication that there's some sort of positive divergence taking place here. And SPY put in a lower low. Okay, and then what took place there shortly after? Well, HYG, because they move pretty well correlated, which I'll show you momentarily, you can see here that this started moving up, and that gave us an indication that potentially SPY can move up too. Well, SPY started ripping up, pulled back, and then we saw some strength. So this means one of two things here. If HYG could continue to perpetuate itself to the upside, the SPY might have a lot more room to run in order to tag that weekly upper expected move. And by the time it tags its upper weekly expected move, that's in correlation or in confluence with the anchored VWAP on the monthly time frame on the month, that could very well start to then take a little bit of a backseat or breath. Okay, now if I break that even further down, and I want to show you this. This is a correlation, right? We're looking at HYG correlated to the S&P 500. We're using 10 trading days, so 2 weeks. And you can see it's typically above zero for the majority of time. At least it has been here in 2022. So what I just want to call out here is when the correlation starts to break and head lower below, around 0.25 to under, I did find it interesting that did mark sometimes tops for HYG, but it also did for S&P 500 here too as well. So as we're coming outside of the weekly expected move, the correlation's breaking down a little bit here. Is that telling us that, hey, this is just going to be a head fake and we're going to start to continue to break down further? That is a very strong possibility, and that you need to be very mindful for heading into the remainder of this trading week. Hope that helps out, everybody. Talk to you later.